We all know this is one of the craziest, least predictable housing markets in history. But we're going to try and make some predictions anyway. Yes, we don't have a crystal ball, but we do have some recent housing market data that provides some information about what could happen this summer. In this video, I'm going to share my top 5 predictions for the summer 2023 housing market and 3 big indicators to look for that could change everything. When I talk about the summer, I'm not using the actual calendar dates of June 21st to September 21st. I'm talking about the typical housing market summer, which are the 3 months of June, July, and August. And obviously, we're about to enter that period, so I thought it would be a good time to make some predictions about what's going to happen during what is normally the busiest time in the housing market. The last predictions I made were back in October of 2022, and I said that prices would fall on a national level in the housing market between 3 and 8% this year. And right now, we're sort of entering that range. The NAR, the National Association of Realtors, has said that prices are down year over year at 2.5%, Redfin's at negative 3%, so we're just starting to enter that range. So far, I think the broad level predictions are good, but things have changed a lot since September, October. So I want to provide some updated thoughts on some of the details about what is going on in the housing market. Before we get to that, I just want to thank our friends at the Short-Term Shop for sponsoring this video. Everyone knows that the most cash flow is in short-term rentals, but you may have zero experience hosting, or you may live in way too expensive a market to invest in. The Short-Term Shop can help if that describes you. With agents in over 20 top short-term rental markets, the Short-Term Shop can find a property for every budget. Plus, their free self-management training leaves you with more monthly income instead of a big bill from a property manager. I have an expensive property manager for my short-term rentals, and trust me, they are big bills. So start investing in short-term rentals today. Head over to theshorttermshop.com/BP for more info. That's theshorttermshop.com/BP. All right, let's get into my 5 predictions for the 2023 summer housing market. Number 1. Mortgage rates will be volatile, but will largely remain the same and stay somewhere between 6.25% and 6.75%. So let me just reiterate that. I do think it's going to fluctuate quite a lot because there's just so much economic uncertainty and turmoil right now, but the Fed has indicated that they could pause rate hikes. I think there is a pretty decent chance that they go back on that and actually raise rates again, another 25 basis points over the summer, but bond yields, which are what dictate mortgage rates, remain low. You know, if you look at this chart, you can see that we've had loads of Fed rate hikes since the peak of mortgage rates for this cycle. Yes, mortgage rates are still up a lot over where they were last year, but they were the highest that they've been in years back in November when they were at like 7.2%. Right now, they're at about 6.5%. And between November and now, we've had a lot, several hundred basis points of interest rate hikes, and mortgage rates haven't really changed. In fact, they've come down a little bit, and I expect that to be the case. Now, I don't think that they are going to go down very much right now because, again, there's too much economic uncertainty. The federal fund rates remain really high, and bond yields are relatively low considering everything going on right now. So that is my number 1 prediction. Unfortunately, don't expect a lot of changes in mortgage rates right now. Number 2 prediction. Home prices will rise from winter lows, but will stay down year over year on a national basis. Every single year, housing prices tend to peak in the summer, and then they go down in the winter. This is known as seasonality. And so what I'm saying with my prediction is that I do think seasonality will return to the market, and we will see the median home price in the United States climb from where they were in January, February, or March. That said, I still think they will be down from where they were the previous year. So we are probably going to remain towards that 2 to 3% year-over-year decline that I talked about at the top of the show. I actually think there's a decent chance, it's not a huge chance, but there's a decent chance that we could see year-over-year growth in the housing market on a national level in August or September. If you just look at this chart here from Redfin, you can see the orange line is this year, it's 2023, and you can see that it is median sales price is starting to trend upward according to seasonal patterns. But when you look at what happened last year in 2022, you see an abnormally large decline starting in June and July. And so if regular seasonality returns where, yes, things start to decline in June and July, but not as much, we could actually see year-over-year growth in the market, which is definitely not something I thought I would be saying at this point in the year. For my third predictions, I said that home sales, the total volume, the total number of home sales, will pick up modestly, but will stay extremely low year over year. One of the main things that has been driving housing market behavior and activity over the last year is that a lot of people just aren't selling and a lot of people aren't buying. That has brought the total amount of home sales to an extremely low level. If you look at year over year data here from Redfin, you can see that they are down 20%. So home sales are down 20% from just last year, and they're down far more from where they were in 2021. Unfortunately, I do think that is going to continue because of my fourth prediction, which is that new listings, the amount of homes that are listed for sale at any given time, will be the lowest on record in July and August. The lowest they've ever been, I should say, in July and August. And for those 2 months, they will be the lowest July ever and the lowest August ever. This has been playing out for months. And if you look at this new listings chart from Redfin, this is seasonally adjusted national data, you can see just how low the number of new listings are, and it is continuing to trend downward. Frankly, I don't see anything in the housing market that is going to make people start listing their house more and more, even they haven't over the last couple of months. So I think this trend is going to continue, and this is going to be a major factor in the housing market over the next at least 3 months and maybe beyond, because people just aren't listing their houses. And that means that inventory stays low. It means that the total number of home sales stays low, and it puts upward pressure on home prices. This is one of, if not the most important reason why the housing market is not crashing despite higher interest rates. It's because there's just not a lot to buy. When you put that in supply and demand terms, even though that interest rates have gone up and demand has come down, supply has also come down, which helps moderate price declines. For my fifth and my last prediction is that regional differences in the housing market will remain and maybe even get more dramatic. We've been talking in the first four predictions, we were talking about national level data, but as you probably know, housing markets are very, very regional. My predictions are that the Northeast will see the strongest price growth, followed secondly by the Midwest and the entire country. These markets just have very, very little inventory, and that will put upward pressure on prices in the Northeast and the Midwest. In the South, I think it's going to be a mixed bag. In the South, you see really strong markets like Miami is just going crazy right now, and there are weakening markets like Austin, Texas. So I think if you're in the South, if you're looking to invest in the South, it's really market by market basis. That's true everywhere, but I think the South is the most difficult to categorize as a region as a whole. In terms of the West, I actually think we're going to see certain markets continue to struggle. Austin, again, I'm going to call that out. Boise, Las Vegas, I think are all markets that are going to continue to struggle this year. But I think there are some markets that actually have been sort of leading the declines across the housing market that are going to start to recover. One that really pops out to me is Salt Lake City. We've seen, it was down a lot over the last 6 months, but I think it's going to bottom out and start to grow again. I think Denver is another market that could do that. Even Seattle's a little bit riskier, but it could start to bottom out and start to grow at least modestly in a year-over-year fashion. That said, I think the spread between the fastest and the slowest growing markets is going to be huge, right? Like over the last couple of years, we got accustomed to everything going up. The worst performing market over the last couple of years was growing at 10% a year, whereas the highest were growing 30% a year. That 20% spread is a lot, and I think that 20% might continue, but we'll instead see 10% positive growth and 10% negative growth. So the spread of outcomes in different regional housing markets is going to be huge, in my opinion. Okay, so those are my 5 big predictions for the summer of 2023. I just want to reiterate that when I talk about predictions, I usually am talking about my quote unquote base case. If you're an analyst, basically what you do is you think about what is the most probable scenario, but you acknowledge that there are other things that can happen. The housing market could crash. It could grow a lot. My base case remains the same as it was in September, October. I think by the end of the year, we're still going to have modest single-digit year-over-year declines, but things are looking a little different than they were in September and October. Frankly, what I think is that there's a better chance right now, as recording this in mid-May, right now, I think the chance of a crash is much lower than a chance of the housing market actually growing in the second half of 2023. And I know that sounds crazy, but just look at the data and the information that you can see, and the chances of a big crash look lower and lower, and the chances of maybe modest growth look higher and higher. So that is what I am looking out for. And again, that is my base case. There are some big things that we need to watch for that could totally change everything, totally change my analysis. Number one is bond yields and mortgage rates. If rates, for some reason, and I'll talk about why this might happen in just a second, but if mortgage rates go back above 7% and stay there, I think that could change. And I do think we could see bigger declines and less likelihood of things actually increasing. But I still don't see a decline of more than 5 to 10% in the national housing market unless rates go above 8 or 9% and stay there. To me, the only reason why mortgage rates would go of 8% or 9% is if the U.S. defaults on its debt due to the debt ceiling limitation. I'm recording this in mid-May, and right now, as we speak, the government is in negotiations, hopefully to reach an agreement, but there is no knowing if that's going to happen. If there is a default, I believe one of the most immediate things that's going to happen is that mortgage rates are going to shoot up. Zillow has estimated that if there is a default, mortgage rates will go up above 8%. And as I just said, if that happens, it is going to really put a lot of fear into the housing market, and it's going to make the housing market even less affordable, and that's going to put downward pressure on the market. So that is really an important thing to look at. So that's my number one thing to look at, is obviously mortgage rates. The second one is labor market weakness. The Fed has repeatedly said that they want to see the labor market, quote unquote, break. They want to see employment go up. That helps fight inflation in their mind. But if you look at some of the data, I'm going to just show one of the measurements of unemployment here, which is continued unemployment claims. You could see that it's pretty flat. Like, it's not really going up in any dramatic way. Despite really high layoffs back in April, we saw the unemployment rate actually go down. There was just so many job openings in the US that despite all these layoffs, people are getting hired really quickly. And I know there is a lot of fear that the jobs that are coming out are, part-time work or people taking on second jobs. But if you look at the prime age unemployment rate, people who are between 25 and 64 who are working full-time, the number who are working full-time is really, really high. So the labor market remains strong, but with all of these interest rate hikes, that is very unclear if that's going to continue. So that's the next thing I'm going to watch for, is will the labor market break, and how dramatic might that be? Because obviously that could have huge implications for the housing market. The last thing I'm looking at is just for geopolitical risks. We already, talked about the risk of default, but there is a banking crisis that has been looming. And if that gets any worse, obviously that could have broad-reaching implications. There's also fear or the chance that there's conflict with China or Russia or Ukraine, something like that could happen. These sort of black swan events that are extremely hard to forecast, but we should all be cognizant are possible and could make, alterations or could change basically our base case scenario that we think is going to happen. All right, so that is it for me. Hopefully these predictions are helpful to you. I would love to hear what your predictions are in the comments below. Thank you all so much for watching. I'm Dave Meyer for BiggerPockets, and I'll see you next week.